When financial systems collapse, people don't first worry about interest rates, stock indices, or Federal Reserve statements. They ask far more fundamental questions. Will the ATM work tomorrow? Can I still afford groceries? Will my paycheck mean anything next week? Can I keep my house? Will I still have a job? 015, 038. These aren't trivial concerns, they're survival questions. And if there's one thing economic history teaches us clearly, it's this: when crisis strikes, survival doesn't reward genius. It rewards preparation. The people who weather financial storms best aren't necessarily those who predicted every twist and turn. They're the ones who built lives resilient enough to withstand the unpredictable. This is Finverse Stories, where we explore the intersection of finance, history, and human behavior, because understanding the past is the best preparation for an uncertain future. 038, 126. Most people think about crisis survival in completely wrong ways. Either they imagine some sophisticated investment strategy requiring enormous wealth, or they spiral into apocalyptic thinking that paralyzes them entirely. History suggests something far more practical. Across depressions, banking panics, hyperinflations, and currency collapses, ordinary people who survived shared a handful of common advantages: liquidity when institutions failed, low debt when income evaporated, tangible assets when paper wealth disappeared, work tied to necessities, not luxury, strong local networks when formal systems broke. Financial crises don't just punish poor investors, they punish fragile lives. Let's explore what that actually means. Lesson 1. Cash access beats paper wealth. 126-11. The simplest, least exciting lesson: having money in an account isn't the same as being able to access it. Before the FDIC was created in 1933, American bank runs weren't abstract textbook events. They were nightmares where families discovered their savings were locked behind closed doors. The FDIC itself acknowledges it was created during the turmoil of the Great Depression, after years when bank failures had devastated public confidence. The difference between someone with immediate cash access or multiple access points and someone with technically existing but unreachable savings could mean the difference between eating and starving. The takeaway: money you can't touch isn't really money at all during a crisis. Lesson 2. Debt becomes a death trap. 11 to 55. During the Great Depression, households didn't fail simply because they were poor. They failed because they had fixed obligations in a world that had fundamentally changed. Jobs vanished. Incomes cratered. Mortgage payments remained constant. Foreclosures swept through entire communities like wildfire. Research on the 1930s mortgage crisis shows how foreclosure pressure helped choke lending and intensify the housing collapse between 1930 and 1935. Translation: leverage that looked perfectly reasonable in good times became a noose in bad times. Lower debt loads matter enormously in crisis history. Families with fewer fixed claims against their future had breathing room when the economy stopped following normal rules. The principle: debt is efficient while the machine runs. When it stalls, debt stops being a tool and becomes a countdown timer to 55. 330. This is why people with modest cash reserves and income flexibility often outperformed wealthier but over-leveraged households. A family with a small emergency fund and no mortgage might have looked less successful than a leveraged family with a beautiful home and higher net worth in 1928. By 1932, those rankings could reverse brutally. History is filled with these moments. Crises don't care who looked prosperous during stable times. They ask one question: who can still function when the underlying assumptions collapse? Lesson 3. Hyperinflation changes everything. 330. For 23. In banking panics, the problem is access. In hyperinflation, the problem is time itself. You can have cash in your pocket and still be losing wealth. By the R. In Weimar Germany during 1922 to 23, the catastrophe didn't just raise prices, it destroyed the meaning of saving. By July 1922, prices had risen roughly 700%. By 1923, millions were ruined as the mark lost value so rapidly that savings and salaries were effectively erased in real time. This changes behavior immediately. People rush to spend wages the moment they're paid. Shops stop trusting posted prices. Cash savings become toxic assets. Time itself becomes the anemeth lesson. In inflationary collapse, the problem isn't earning too little. It's holding the wrong thing while waiting for stability that never arrives. Lesson 4. Useful assets outlast abstract wealth for 23L511. This brings us to perhaps the most important practical lesson in all of crisis history. Useful assets matter more than paper wealth when trust breaks down. In Weimar, people with access to foreign currency, inventory, productive land, tradable goods, or businesses tied to daily necessities were in a completely different class of safety than those whose security depended on cash. Keeping its meaning, the point isn't that everyone should panic buy gold or farmland. The point is simpler. When monetary systems become unstable, value migrates toward things people can use, trade, consume, or understand immediately. A stocked workshop, farmland, inventory, fuel access, durable goods, or income from essential services can matter more than a beautiful portfolio statement from 6 months ago. What survives isn't always what looked most elegant before the panic. Lesson 5. When formal systems fail. Local networks matter. 511-627 Argentina's 2001 to collapse wasn't just a sovereign default or currency crisis. It was a liquidity breakdown that invaded daily life. Bank runs and withdrawal restrictions left people confronting a harsh reality. They no longer trusted formal money and formal finance to function normally. That's why barter clubs expanded dramatically. Research describes how foreign capital flight and the banking run produced a severe liquidity shortage in late 2001, pushing communities to create local exchange systems when ordinary cash and credit channels were failing. This is extraordinary because it shows what people do when official systems freeze. They don't wait for economists to fix things. They rebuild exchange as locally as necessary. The Argentine experience teaches two lessons simultaneously. Local trust becomes economic infrastructure when formal trust collapses. Adaptable income beats static prestige. 627, 658. In stable periods, glamorous income looks superior. In crisis, useful income matters more. People tied to food, transport, repair, local distribution, essential services, or practical trades often weather breakdowns better than those whose income depends on credit booms, discretionary spending, financial euphoria. Depression era survival involved odd jobs, family labor pooling, side income, informal repair, and local production. During later crises, the same pattern appears in different forms. Income connected to necessity survives longer than income connected to confidence. 650-80, 732. This is one of the clearest historical patterns. Yet almost nobody discusses it enough. Local trust becomes economic infrastructure when formal trust fails. Family help, neighbors, community credit. Local sellers who extend flexibility, mutual aid, barter. Informal work all become more important when banks, wages, or money itself become unreliable. This doesn't mean community is a full substitute for a functioning monetary system. It's not. But it does mean resilience is wider than a portfolio. A person with a great brokerage account but no trusted network may be more fragile than someone with modest savings, practical skills, and strong local ties when institutions freeze. Trust doesn't disappear, it gets forced down to the local level. The real pattern, low fragility. 732E8, 18. This is where many expect a neat shopping list of assets to buy. History doesn't work that way. It doesn't reward one perfect instrument. It rewards a pattern. That pattern is low fragility. People survived banking crises better when they weren't fully dependent on one bank. They survived depressions better when they weren't over-leveraged. They survived hyperinflation better when they weren't sitting passively in cash. They survived liquidity crises better with useful goods, skills, or local networks. They survived social breakdown better when someone nearby still trusted them enough to trade, hire, lend, or help. A portfolio is not the same thing as resilience. In many historical crises, resilience had as much to do with household structure, debt load, and community ties as with formal investing. That's why a genuinely useful historical lesson is this: diversify your dependencies, not just your portfolio. People obsess over whether their investments are diversified while leaving their actual lives dangerously concentrated. One bank, one paycheck, one debt structure, one city, one fragile supply chain for essentials, one set of institutions they assume will always function. History reminds us repeatedly. This kind of concentration is often more dangerous than owning the wrong stock. 850-0932. The most dangerous concentration in a crisis is frequently not in your holdings, it's in your assumptions. If all your cash flows through one stress system, if all your income depends on one vulnerable employer or cyclical sector, if all your security depends on stable prices and uninterrupted convenience, then your life is less diversified than you think. This is also why emotional discipline matters, though people hate hearing it because it sounds boring. In crisis history, panic is expensive. People who rushed into the wrong thing, sold at the worst time, hoarded what they couldn't use, or ignored obvious fragilities because normal life trained them not to worry. These people often made their situations worse. 932 to 1006. The people who came through best weren't always the smartest in conventional terms. They were often the ones who recognized early that the environment had changed and adjusted before everyone else was forced to. They cut leverage early, moved quickly while cash access was still available, spent weak currency fast when holding it no longer made sense, accepted smaller, local, less elegant solutions when big systems stopped delivering. On serious crises, survival is usually built from adaptation, not pride. What this means today, 1006 to 1053. So, what does all this mean right now without turning this into fear-mongering? It means you don't need to predict the exact next crisis to learn from the last 100 years of them. You don't need to know whether the next shock looks like a banking panic, inflation surge, sovereign crisis, or something entirely new. The recurring protections stay surprisingly constant. Cash access matters, low leverage matters. Practical assets matter, flexible income matters. Local trust matters. Person who can absorb disruption generally survives better than the person who merely optimized for normal times. That's the historical pattern, and it's a far more useful guide than pretending the future will reward cleverness alone. Final thoughts, 1053 to 1112. Financial crises always look unique while they're happening, but the people who come through them best are often protected by the same timeless principles. They can access their money, they owe less than their neighbors, they own things with immediate value, they can earn in adaptable ways when institutions weaken. They're not standing alone. If this isn't glamorous, it will never sound as exciting as a bold market prediction or miracle investment, but when systems break, survival gets simple again. 1112 to 1120. The people who make it through usually aren't the ones who guessed every shock. They're the ones who built lives resilient enough to absorb one. If this changed how you think about financial preparation, subscribe to Finverse Stories. Because in finance, the past is prologue and the best protection is understanding what's already happened. History doesn't repeat, but it rhymes. And we're here to help you hear the rhythm. Asterisk.